So our focus this year, we just started our new fiscal year on October 1, is we really want to be known as more than just a bank. We have developed a number of subsidiary businesses that support small businesses that are affiliated with the bank. I want to make sure you all knew what that suite of services is. So we have a bookkeeping service that provides basic bookkeeping services through QuickBooks at a very affordable rate. We don't compete with our friends in the CPA world, so we're not going to be doing tax returns or high-level consulting, but we're basic bookkeeping for small businesses at a below market rate in most cases. The other thing that we've put together in the last couple of years, we have an IT services subsidiary that provides basic network, hardware, software setups, and more importantly these days, cybersecurity has become a major issue, not just for the bank, but for our clients. We've had some clients get hacked, lost some valuable working capital through fraud. So we are really focused through our IT sub, Matt McCullough is here in the room, who runs that, on helping small businesses be secure from a cyber perspective. In addition to that, we have marketing services available through Ryan Nolf. Ryan's up here in the front. That can include anything from traditional print type marketing materials to electronic media. Ryan is a full-time AV engineer. We have a podcast studio next door that's available for use by small businesses that want to get involved in podcasting, that want to do audio-visual type digital media for their social media outlets, for their websites, for a number of different purposes. We also have, on the real estate side, we have several subs that support the real estate, our real estate investors and our real estate owners. We have a title company known as Property Closers. Jenny Butler's in the room. Jenny's in the back, runs our title company. We also own a full-service commercial and residential real estate brokerage with offices in Indiana, PA, and here next door to the bank in our offices building, which is right next to us. They provide help with site location. They provide help with buying and selling properties, lease negotiations, all those types of things. So all this suite of services, you're going to see us start to promote as a whole ecosystem or a family of companies that can support small businesses. All of these programs are focused on the small business client. So where you might not get attention from certain other larger firms in these spaces, we are focused on small businesses, anywhere from startup up through established businesses. Our final thing I want to talk about is our club. So we own the building next door, as I mentioned. On the top floor of that building is a very high-end co-working, networking, and educational venue, which we call the Club at Enterprise. We recently rebranded that. Memberships are available. You can use that space as your office space, either permanently or intermittently. You can use it as meeting space for your clients and employees. And we have educational networking events there several times a month. Kelly Rohr is our member concierge. When we're done with this program, if you have any interest in taking a tour of the club and seeing the space, I think you'd be highly impressed. Kelly can take a group of you over there after we're done here today. And there's some flyers in the back on the club programs and on the membership packages available. All right, with all that said, back to our topic. So want to introduce our speakers, Tom Golden and Brad Jadlowick from Knoll Sherry Lyon Associates. They're a full-service CPA firm located just down Mount Royal Boulevard from us, very close by. We've had a great relationship with these guys for a number of years, and they are going to help you kind of digest what's going on with the latest legislation and how it's going to impact you from a tax perspective. So I'll turn it over to Tom and Brad.
Morning, everybody. Just special thanks for Enterprise Bank for setting this up today, and thank you all for coming. So just to get into it here, we have the One Big Beautiful Bill Act, which I'll be abbreviating as B3 or 3B throughout this. It's just a lot to say. So this was signed July 4th this year, 2025. Structures of the budget reconciliation package to circumvent traditional filibuster requirements and, strategy and how they got the law into place. Goal is to realign the federal priorities with this current administration and economic and social vision. It will deliver more than 1.5 trillion in spending cuts, reshape federal policy across nearly every major sector of American economy. It should impact every industry and household in the U.S. The major parts of the bill were spending cuts, immigration, defense. Obviously, I'm not going to get into those three, and then tax cuts. Bill generally extends or makes permanent expiring provisions of the Tax Cuts and Jobs Act, and enacts some campaign promises and repeals, modifies, or large portions of the Inflation Reduction Act. If you recall, the Tax Jobs and Cuts Act was the first Trump's legislation began in 2018, which introduced QBI deduction, among other tax provisions. So a lot of part of this bill is extending a lot of those things that were in that bill at the time that were set to expire at the end of this year. Budgetary impact. So a report by Congress Budget Office released on Tuesday, this is probably dated Tuesday a little while ago, but would increase the federal deficit by $3 to $4 trillion over 10 years. I think the goal was also in the spending. Obviously, none of us like that, the sound of that, but the goal would be to, with the spending cuts and other parts of the bill, probably offset that. But we'll see how all that goes. To get into the general, I'm going to talk about the business provisions, and Tom later will get more into the individual aspects of the law here. So one thing that this law permanently extended that was part of the original Tax Cuts and Jobs Act was excess business loss limitations. So it permanently extends it. The provision was slated to expire in 2028, actually, and they did threshold amount to index with inflation. So what that is basically when you have, we all have small businesses in here, and you generate a loss in that business, there is, once you reach a certain level of income, it can minimize the amount of that deduction, that loss in your business that you can use to offset other income. So for example, if you make $1 million in other sources of non-business income and you create a $1 million loss in your small business, that $1 million will be limited in that year. Those losses do carry forward, but that was put into place to try to actually increase taxable income for that year. So that is still in place, but the thresholds are fairly high, so it may not be an issue for you. Also, at any time, if you have a question or want me to stop or redo something, just raise your hand. That we don't need to wait to the end or anything if you have any questions. As I mentioned before, it's going to be extending Section 199A, the qualified business income deduction, which I would say all of us in the room that own a small business participate in. Again, this deduction, it keeps the deduction rate at 20%. It also has expanded for SSTBs, the phase-out thresholds. So for example, I am an accounting firm and I provide a service. So I'm subject to depending on my income level, phase out of that QBI deduction. So they've expanded that phase out range by basically 50,000 for a single and 100,000 for married filing joint returns. So some of you that are in the service type industries, you may be able to qualify for that deduction where you wouldn't have in the past. They also introduced a minimum deduction available, $4 for taxpayers of at least 1,000. So maybe somebody has a small Schedule C or something that could be a benefit. Research and development expenditures. The bill now allows for immediate domestic expense deductions for the domestic R&D expenditures under this code for the tax years 25 through 29. Foreign expenditures must still be capitalized and amortized and may not be recovered either as a deduction or reduction in the amount realized for any project disposed, retired, or abated. Small business taxpayers with an average annual gross 30 million or less will generally be permitted to apply the changes retroactively to tax years beginning after December 30th, 2021. So if you have R&D expenditures, what this does is allow you to deduct in full instead of under the old rules where you'd have to amortize and take over time. And for small businesses, if you had this going on, it would allow you to go back and expense these items. You also have the option domestic research expenditures for December 30 after December 21 and before January 25 will be permitted to elect accelerated rate deductions over a 1 or 2 year period. So again, it's allowing us to go back and things that you have had to capitalize and amortize to go and get those deductions. Business interest expense. This may not apply to a lot of small businesses, as if you're under 25 million in revenues, you don't necessarily need to follow this limitation. It's a limitation is what it is. And how it works is, for example, if you have taxable income, let's say $5 million, you are limited to 30% of that number of 5 million, so 1.5 million as interest expense. So in that scenario, if you had $2 million of interest expense, you could only deduct 1.5 million. Again, you don't see a lot, and I don't see it a lot in my world with the small businesses I work with. But that is continuing on. And then they also allowed for a restatement of the EBITDA limitation, which basically allows when you're calculating your taxable income and the limitation, you get to add back those deductions, which would increase your available interest expense deduction. Bonus depreciation. This would be definitely more useful to most of the folks in the room. Permanently extends the 100% bonus depreciation for property placed in service after January 19th, 2025, and before January 1, 2030. So again, with bonus depreciation, it's an accelerated depreciation method. We're buying equipment, we're buying, certain vehicles. We can take a full deduction for that. Not much unlike what Section 179, but this bonus depreciation will allow us to create losses where Section 179 would not. Yeah. Service. It's placed in service of the rules. And just getting back to this slide too, real quick. There is a temporary allows election 100% depreciation for qualified production property. A good example would be, you're building, and you have to have a qualified production activity. So think of a machine shop, taking steel rods and making bolts, right? So manufacturing. If you're constructing a building or there's real property involved, typically we have to do 39-year depreciation on that. This allows for maybe expensing 100% of that in that year. So getting 100% deduction in 1 year is possibly way better for you than depreciating over a 39-year period. Section 179, this has been around a long time. So what this law is doing is it's increasing the deduction amount to $2.5 million, and the threshold amount to $4 million. The old rules were $1 million and $2.5 million for the threshold amount. So what that means is if you bought $5 million of equipment in 1 year, you would be limited. You would get limited out to what you could deduct as Section 179 expensing. And what that is writing the whole asset off in the year that you place it in service. Actually, 25 limits are 1.2. They're not in the slide, but they were 1.25 million, and the threshold amount was 3.13. So this is beginning in 2026. These numbers I have up on the slide, so it's not a 2025 change. And this Section 179 is generally can be preferable because many states, as we talked about bonus depreciation, don't conform to that federal law. So where we write something off at 100% for bonus, the states do not allow that. So you can elect out a bonus and take 179. Like here in Pennsylvania, actually Section 179 was limited to $25,000 many years. A couple of years ago now that had changed where they conform to federal. So we can match that up and get the deduction at the state level and not have two sets of depreciation tables going on. So it makes it a little easier with planning, having that. Employer provided child care credit. The law allows for an increase in this credit from 25 to 40%, not to exceed 500,000, and 600 for small businesses, and they will be adjusted for inflation. So, if your company is providing some type of benefit to the employees, there are credits available for that related to child care. Family and medical leave credit. This is permanently extended. The credit, it's not up on the slide, but it ranges from 12.5% to 25%. You get it. The increase is based on, you have to have a policy in place where you're going to pay medical leave for full-time employees. There are some rules around that. You need to have a written policy. So if you have an employee that is full-time and you're paying them $1,000 a week salary, and they have to go on medical leave for whatever reason, and you continue to pay them that $1,000, you're eligible for a credit for that. The law also is if you have a insurance policy for that, based on the premiums paid, when the insurance policy is paying your employee, you can get the credit for that as well. Advanced manufacturing investment credit. This increases this credit from 25 to 35%. Starts after tax year 25. So advanced manufacturing, we're thinking semiconductors, those kind of things that would be eligible for this credit. Corporate charitable contributions restricts the charitable deduction for C corps to the extent charitable contributions exceed 1% and not to exceed 10%. So of your net taxable income. So if you have contributed less than 1% of your net taxable income, there's no charitable deduction. Once you exceed that, then it's allowed, but it doesn't go over 10% of your charitable deduction. Anything that is not deducted over the 10% would carry. So the observation is, again, would effectively lose charitable deductions amount to equal to 1% taxable income. The next two bullet points were a slide I was going to put in, but I forgot to take it out. It has to do with public companies, so we can kind of ignore that. But there is limitations are going into place for compensation on highly paid. Qualified opportunity zones. This kind of can cross into both business and more in an individual side. The Qualified Opportunity Zone program, it was created to stimulate economic development in stressed communities and offering tax incentives to have people invest in those. The current program is winding down. This bill creates a new one using some modified eligibility requirements and additional tax return and reporting requirements. The current QOZs were going to expire in 2026, and instead that is going to 28. Bill has the governors will designate the new QOZs, which will be then effective from January 27 through 2033 of December. And some of the requirements, the greater of the 33% of U.S. population within rural areas must be low-income communities that are comprised entirely within rural areas. Not off the top of my head, but I can figure that out for you. The low-income communities, for the purpose of the next round of qualified opportunity zone designations, new requirement results in a reduction of the amount of areas that will qualify as compared to the overall population of areas that would have qualified under the original designation thresholds. And what this is, right, from a tax, like, how do we use these things, right? So if you were to like sell your company's stock, for example, you could reinvest that money into one of these funds or a qualified opportunity zone and then defer your gain on that stock sale. So when it comes from a planning perspective, obviously it locks up cash, right? So the idea would be to defer the tax. But that is the tool that this is for, and then it also gets the communities reinvested in. But that's the tax incentive that we all would have to participate in something like this, to have that deferral of that gain. And that's kind of what this slide's talking about here. Taxation of capital sale property invested in a qualified opportunity fund. Again, this is after January 2027 for the new rules, will be deferred until 2033 or the date that that investment got sold. So you got to have a long time of deferral on that gain of property that you had sold. Then once an investor holds an interest in the fund for 5 years, the investor obtains a 10% basis increase, which will ensure only 90% of the deferred gain is taxed. So they're wanting people to hold on to these things to benefit the communities, and then so they're giving some tax advantages. They also give you, under the bill, ability to defer up to $10,000 of ordinary income. And once the investment is held for 10 years or more, no taxes imposed when the investment is sold. Deferred gain invested prior to January 27 will be recognized by the end of 26. That has not been extended. So that's under the old rules for that. So again, there is more reporting required under this. Comprehensive reporting tax return requirements to existing, increased penalties to ensure compliance. Okay, employee retention credit. So we all remember employee retention credit, you know, is credit that you could claim for paying payroll during COVID. So what they've done is in this bill is any claim after January 31, 24 is just going to be disallowed regardless of whether such claim was timely or in the validity of the filed under existing law. I think most of us that would have qualified for that has probably already done so. And so this, you know, wouldn't have been a problem by January 24. Since the statute of limitations expired filing the earliest ERC claim, which was April 2015, 2024, this change has the potential of retroactive delaying bona fide claims filed by businesses and tax-exempt organizations related to both calendar years 20 and 21. ERC claims will now be considered a listed transaction. So what a listed transaction is, they're looking at specific groups that used ERC promoters. So yeah, everybody heard the radio ads during COVID, you know, come use us with the ERC. I think there was a lot going on that was not on the up and up. So the goal was maybe to go and target some of these places. And so what a listed transaction is, it's a tax avoidance scheme. That doesn't apply to any of us. The bill also extended the statute of limitations on assessments to 6 years for ERC claims. Typically, the statutes run a 3-year period. So instead of 3 years to go back and look at the tax returns filed for these credits, they have 6 years. And the dates, how that gets generated is generally the date the original term was filed under Code Section 6501, which is kind of basically, again, the dates things are filed, or the date on which the claim for credit or refund for ERC was made. So if you made a amended return for a period in 2020 and 2021, that's your and you file for that claim, that's your 6-year start. They put in the bill ERC promoter penalties. So as we talked about, you know, all these companies came out of the woodwork during this time. And so now requires ERC promoters to comply with due diligence requirements with respect to the taxpayer's eligibility or subject to a penalty equal to the greater of $200,000 or 75% of gross income derived. So basically their fee. And then a $1,000 penalty for each failure to comply. It also extends the 20% penalty for excessive refund claims to employment tax. So they're really wanting to, you know, if something went wrong, they're trying to put some teeth on this to penalize these promoters. Form 1099 reporting. So for many years, the 1099s, we've all had to prepare for vendors. We've always looked at the $600 threshold. Starting next year, 2026, that threshold is going to move up to $2,000 in a calendar year. So we will only be required to 1099 subcontractors, vendors. We usually have to, if it exceeds 2,000. So maybe a little less paperwork, maybe not. We'll see. Also for Form 1099K, that's, like credit card transactions, I think PayPal, Venmo, that was set to go down to also to $600, but it's revised to transactions exceeding 20,000 or an aggregate number of transactions exceeding 200. So a lot of people were worried about moving money between people that is not business related and getting 1099Ks. So they're moving them back up, to more of a business level type of transaction setting. Any follow-up questions on business? We're going to get into individual tax stuff now with Tom. Can save it until the end as well, but if not, move on. Right.
Hi, everyone. With the individual tax rates being made permanent, it's now going to make planning going forward much better for everybody, particularly in businesses. When we have expiring provisions like we had, we would have had next year effectively a massive tax increase, which then from a CPA perspective, we would have been doing all kinds of planning this year, possibly to accelerate income into 2025 and defer expenses into 2026 because the tax rates would have gone up. And so now it's going to require then in the future, with this being permanent, that it's going to take Congress to vote for an actual tax increase in the future, which is going to make it politically difficult to do in the future. And we'll know exactly what's going on once once there's a change in power in the future, if that occurs or when that occurs. So basically, the rates were modified. There was a slight increase in the rates for the 22 or the 12% bracket to help prevent some bracket creep, but basically they were kept the same as they were prior. They're indexed with inflation, and they go up every year, and they normally get announced in the fall of the year prior to the tax rate year. The other thing too that was made permanent was the increase in the standard deduction, which most everybody knows. Many people have not been filing a Schedule A for years, and with the state and local income taxes being capped at $10,000, with mortgage interest rates being low historically before, then we would only be able to have clients that were actually itemizing if they had significant amount of charitable contributions. So these changes have been made retroactive to include 2025, and like I said, will be adjusted for inflation going forward. The other permanent extension is the elimination of the personal exemption. And what they did do, though, because of Trump's willingness to or wanting to make Social Security tax-free, they instead added something that's similar to an exemption, and it was an exemption for retirees for $6,000, but it's a phase out of based off of your modified adjusted gross income. So it's only going to benefit folks that are going to be likely in the 22% bracket or lower. So no one above that will have that deduction. And this deduction is only going to be in place for a few years through 2028, which is when the next presidential election will occur. So this will automatically go away in 2029. This is not a significant planning thing, but it is going to go away. So the child and dependent care credit. So this had this was also made permanent. There is, you can have a very large credit for this. However, it's mainly for folks with adjusted gross income 15,000 or less. So it's probably not anybody in this room. Basically, most of you will end up with the regular rates that you have been getting, which is typically around 20%. And that's the lowest credit you would get regardless of what your income is. They did add for lower income taxpayers the ability to have a portion of the child tax credit refundable beginning in 2025. The $1,400 refundable tax credit is adjusted for inflation and is made permanent. So again, this is a low income item, and it's basically to try to assist people in low income to be able to afford daycare and be able to actually work. And then the income phase off for this is $200,000 and $400,000 in case of a joint return. And then the $500 non-refundable credit for each dependent of the taxpayer other than a qualifying child is now made permanent. The AMT exemption, most people have not been in AMT for a while because of the disallowance of the SALT, the state and local income taxes, which was a significant tax preference item. And but they did make an adjustment to this because of the adjustment that I'll talk about with the SALT later. It's still going to be difficult even with a raised SALT to be in alternative minimum tax, but we are going to see more of it going forward. The other large item is the no tax on overtime. B3 basically set it up so that you could have a deduction for overtime of $12,500 for single or $25,000 for married, filing joint. And this is only on the overtime portion. So if it's time and a half, you get it on the half. We have not seen the W-2 that's going to have, where they're going to actually put that in W-2s, but it's supposed to be getting modified to include that. This too also has a phase out, so it's mainly set up for the lower income taxpayer. Not that 150 to 300 is low, but it's basically not going to allow. They do this to allow it so that you don't save taxes at a much larger tax rate. So the waitress that's working, and that's all her job would be, she would likely only have been in 12% bracket anyway, and possibly even 10%. It's not going to have a significant tax impact for them because they weren't paying income tax in the first place. Let's see. Oh, I was talking about the no tax on tips. The overtime, so that I was talking about the tax on tips. So that basically follows very similar to the overtime with the limitations. This one is also ends in 2028 during, at the election time. We're going to, the waitresses or people that were servers, the tips were always shown on the W-2, so that's still going to continue. One thing that has changed was the see this in the next slide. I'm going to be talking about the okay, so student loan debt discharge. They changed that to make permanent some adjustments for the provisions for this for the gross income from student loans that are discharged on account of death or disability. Basically, they're making it so that if it's a death or disability, it's not going to be taxed. However, they're going to require that the inclusion of the taxpayer's history number on the relevant income tax return when the student loan is discharged. Okay, so what they did with the 529 is the bill expanded the definition of qualified 529 expenses to include other costs beyond traditional college tuition. This includes K through 12 tuition, and now it has curriculum materials, tutoring, and even dual enrollment fees for college courses taken in high school. It also allows the use of the 529 funds for expenses related to post-secondary credentialing programs, such as those as trade schools or for certifications and licensing. They're trying to get it so that it can expand to more trade school learning because we obviously need more folks in the trades, so they wanted to emphasize that. ABLE accounts, if you're not familiar with them, are savings accounts that are created for persons who have disabilities. So the contributions to an ABLE account are made on an after-tax basis, similar to how a 529 contribution would be made, but the money grows tax-free, and withdrawals for qualified distributions are also tax-free. This is for folks that have children that are disabled or potentially become disabled. And because a lot of times what would happen is I've had clients where they had 529 plans set up for their children, and the child had something occur like an automobile accident, and they were unable to use that for tuition. So in lieu of having to take out the 529 funds, they converted the 529s to an ABLE account so that the child would have funds available in the future for health, education, maintenance, or support, or to cover their basic needs that would not be subject to Medicaid or SSI benefit reductions. The age of eligibility was expanded from 26 to 46, and this was made permanent. The other thing that they have too is similar to the retirement tax credit, is that contributions made for taxpayers that have a lower amount of income. There's a retirement tax credit, for instance, if you're married and you make less than $50,000 and you defer to a 401k plan, make an IRA contribution or a Roth IRA contribution, there's a credit that you can get for a retirement savers credit. So there's also a credit for setting up an ABLE account for a beneficiary where you could get a credit. So if you had a taxpayer who was making less than $50,000 a year and had a disabled child, they could effectively get a subsidy for their contribution to the ABLE account for their disabled child. One very new thing is the Trump accounts, which still, my understanding is they're not going to get set up fully until July 1st of next year. This basically allows for individuals, grandparents, parents to make a contribution to a Trump account for their child if they're under the age of 8 of $5,000 a year. And what happens for children that are born in the next 25 to 28 is the government's going to actually provide a credit of $1,000 for the child's account. And so while a Trump account can ultimately be used for education as well, other than, if it was me, other than obtaining the $1,000 tax credit that would be for the $1,000 amount for setting up the program, I personally would try to max out 529 plan first. And then if I had excess funds, I would start contributing to a Trump account. Okay, and then the other thing too that's different with this as well, when the income comes out, when the assets come out, it's going to be handled similar to an IRA account. So what gets contributed is going to be considered what would be a non-deductible IRA contribution. And normally then in an IRA, if you pulled it out, the income would have been subject to ordinary income tax. So when someone takes a distribution of this in the future, the distributions are only going to be taxed at the capital gains tax rate. And having it at the capital gains tax rate, for instance, like if a child was going to use the funds when they're 20 years old or 22 years old, and they take $10,000 out, there's a high probability that since capital gains tax rates for single persons under a certain amount of money, which is probably like $48,000, has a 0% capital gains tax rate. So they made it so that you would have the ability effectively to get the money out or some of the money out at a 0% tax rate. So it's possible to use these funds in the future without having any income tax. If the distributions are not used for qualified purposes, such as starting a business or buying a house, then it will be subject to a 10% penalty on the income that gets distributed, just like it would be for a regular IRA. And then once you achieve age 31, the account is deemed to be fully distributed to the beneficiary. So you have to have these funds spent before you're 31. So on a qualified purpose, or you'll have a 10% penalty. Other item that's new is that gambling losses now will be limited to 90% of the games. So they did this basically to make it so that if you win, currently, if you would win, you would have a dollar for dollar deduction. They're making it now so that you effectively have to pay income taxes on income that wasn't really income. There's a number of states that have that, where you could have $1 million of income and they allow no deductions, and you pay tax on gambling winnings that you never actually had income on. So this is kind of getting in line with what a lot of some of the states are doing. This also goes into effect January 1 of 26. The other new item was was personal vehicle loan interest being able to be deducted if you purchased a vehicle with a loan in the final assemblies in the United States. I assume the car dealers are going to tell you whether or not it would qualify or not. I suspect there might be some reporting for this as well. So it may be something you don't have to think about, that you might actually get some type of 1099 for it, saying that you had qualified automobile interest. I'm not sure. It is also phased out with AGI, which then makes you wonder how you could have $10,000 of interest on a car making $100,000 or $150,000. But so they also enacted this contributions to scholarship granting organizations. We've seen some of this with state tax law too. I assume that there's going to be organizations that are setting these up so that in effect you will make a contribution to a scholarship granting organization, which is the scholarship granting organization is going to be a school that you make the contribution through, and they're supposed to use it for students. And the limitation is 300% of the mean and of the mean income. So this could be for relatively high amounts available. I'm wondering if, when you do this, if somehow the school's going to direct your scholarship granting organization contribution back to your child. The other item that's going to begin after 2025 is we're going back to having the ability to make a non-itemized deduction for charitable contributions for folks, single folks, of $1,000 and $2,000 for married filing joint. The amount of the individual's contributions for a tax year is reduced by 0.5% of the taxpayer's contribution base for the tax year. Brad already brought up for corporations, the floor will be 1%. And so that we've already discussed the corporate. And again, this is effective after this year. The other thing which is good, having it be permanent as well, is we were initially looking at the exemption amount reverting back again to 2017, which then previously we've had problems where we were having clients making gifts large gifts to try to use up their unified exemption amount. And having this made permanent helps with planning for estates as well. So so how this all works is it's a unified exemption amount. So what this means is when you're making gifts, if you don't know, when we file gift tax returns, I could make a gift to my child if I was single of $15 million, and none of it would be taxable because I would file a gift tax return that would use up my $15 million. And then when I pass away, my exemption amount would no longer be $15 million, it would be zero. So the reason folks would be giving away money when they think it's going to decline is because if I give away my $15 million and they change the law to $5 million, I'll have been able to give away $10 million without having any gift tax. And they are going to inflation or have this inflation adjusted as well. So this will go up every year. This should cover probably 95% of all the estates out there. The other item is the mortgage interest. It basically made permanent the $750,000 limit. And it also makes permanent the exclusion of interest on home equity indebtedness from the definition of qualified resident interest. And that means that you can't, like prior to this, we used to be able to have $100,000 of home equity indebtedness that we could deduct the interest on as an itemized deduction. That was eliminated with the last bill. But you're still able to use it to build or improve and still be able to take that deduction. But it's basically you have to be able to document the use of those funds. And then what they also added as well was they're bringing back the deduction for mortgage insurance premiums on acquisition indebtedness as qualified resident interest, but that too is limited by adjusted gross income. So a lot of taxpayers will not be able to qualify for it anyway, and we still have a high exemption or standard deduction, so it's still going to be difficult. And this is also beginning after December 31 of 25. So what the bill also brought back into play, probably because of the increase in the SALT deduction that we're going to be talking about, they brought in the phase out of itemized deductions. And what they do when they do these calculations, the purpose of the 537s or 237s is they're basically trying to make it so that if you're in a 37% tax bracket and you're able to itemize, that you're only going to get a tax benefit at a lower rate. So the 237s might make it so that you're effectively getting a tax deduction at 35%. And it's the same with the 537. So all it is basically saying, well, we're going to allow you to have a deduction, but we're not going to let you have a deduction at the maximum marginal tax bracket. The personal casualty losses have not been allowed for a while, except for federally declared disasters. They just made that permanent, and but they did expand it so that now certain state declared disasters can qualify. And I think that some states were complaining that that they were not getting federal declarations, even though they believed that they qualified. So now it'll give states some power to be able to influence federal taxation by having a state declared disaster. All right, so this is the biggest change in itemized deduction. It's the SALT deduction, which is state and local income taxes. With the prior act, we were limited to only $10,000 of state and local income taxes. So it'd be real estate taxes, state income taxes, local wage tax, and there was a fairly large outcry in high tax states like New York, California, New Jersey, and there was a push to increase it, and it also had some bipartisan support for Republicans that were elected in those states. They too were under pressure to try to get this to change. So What they did though for the SALT is that, again, they're always trying to limit somebody from getting a tax deduction at a higher tax rate. So what they did is they said, well, if you're over $500,000 of modified adjusted gross income, we're only going to we're going to phase it out between 500,000 and 600,000. And if you're below that, then you would be able to have the full amount. It will be subject to AMT again, although I still don't think we're going to see many people in an AMT situation. So what happens is the phase out between, since the deduction for married filing joint is $40,000, the 30% of the reduction, the phase out deduction of 30% is basically if you have $100,000 of income over 500,000, then that's $30,000, and it gets you back to the $10,000 deduction. And so the SALT deduction will never go below $10,000. And they did also, which was not on the bill prior or on in law prior, is they've made it so that this is adjusted for inflation, and they also have an increase of 1% annually through 2029. And then in 2030, this will expire and it'll go back to the $10,000 that we currently have. We put the bicycle thing in, but it's probably rare that we see any of that. The key item on this is the deduction for moving expenses is permanently eliminated except for members of the armed forces and certain members of the intelligence community. So basically moving expenses, we used to have a deduction for it prior to 2017. They decided to make that permanent, that you can't have a deduction. There were some modifications to the health reimbursement arrangements. Mainly is when you're Medicare eligible to remain eligible for contributions to an HSA, you can only do it if you're enrolled in Medicare Part A. If you're in Part B, you do not qualify. So they did add things in there too, like for, the trade expenses paid for physical activities like fitness clubs and amounts to be able to be used for an HSA. And it does allow both spouses to make catch-up HSA contributions to the same HSA, provided one spouse has family coverage under a high deductible health plan. So that was put in basically because some spouses will have their health insurance separately, and one might be in a high deductible and the other will be in a traditional retirement plan with not high deductibility. They do allow for the more of the FSA and HRA funds to an HSA. Well, and the other change too was for the adoption credit. They made $5,000 of it refundable. Typically, it was a credit that would just carry forward. So they made it so that now you have a portion, and they also increased the maximum amount excludable on income of 129 dependent care assistance program. It increased from $500 to $7,500, which is a pretty substantial increase. But the daycare costs have gone up so much. I think they've recognized that needed to increase, and it was never indexed with inflation. And also the B3 imposes a Social Security number requirement for claiming an American Opportunity or Lifetime Learning Credit. Basically, I'm not sure how much I want to go into detail on this, but a lot of the energy credits that were in existence are phasing out. And the reason that they're picking those dates into the future is because there could be projects that were already underway and there were commitments that were made. So they're going to allow it so that these jobs can be completed and still be eligible for the credit. So it'd be like committing to invest a couple $1 million and then have the law change. And because you didn't place it in service or complete it, you would have lost that credit. This is supposed to give folks enough time to be able to finish their projects and still be able to claim the credit. So these are additionally some of those provisions that were terminated. Apparently, there's a firearms transfer tax. The bill reduces the transfer tax on certain firearms. Adds a new section 1062 that allows income tax resulting from the sale of a farm land to a qualified farmer to be paid in 4 annual installments. Probably not applicable to most people. There were some provisions that were in there, and that's the problem with listening to the radio or watching the news, is people hear what's being proposed, or they read one bill, the Senate bill versus the House bill, and start believing that it is law. So you typically want to try to stay away from listening or reading anything until the final bill comes out, because there's a lot of things that they'll talk about that's in there that doesn't end up in the final bill. And these are some of them. That's it. Does anyone have any questions?